Welcome everyone to this 10th July edition of Mango Spaces, pretty much right at the start of the second half of 2025 and also the start of an entirely new fiscal year. Over the course of the hour, we're going to be examining the state of what is, at least for the time being, still East Africa's biggest economy. And the data in and of itself can tell a very interesting story, depending on whether you look at an entire data set or you look at specific items in isolation. For example, we would say that inflation is comparatively low, 3.8%. That's not necessarily a bad number. We're seeing interest rates on treasury bills back into single digits. But a lot of these positive data points, if you want to call them that, are nowhere near enough to paper over the glaring cracks in the economy at the moment. For example, yes, inflation may be comparatively low, but you're paying anywhere between 12 to 20% more for staples like tomatoes, carrots, maize flour, and so on and so forth than you did a year ago, right? Private sector credit growth. There are plenty of entrepreneurs who are listening to this at the moment. You know how hard it's been to get credit in the last year. And for that reason, private sector credit growth, which used to be over 11% on an annual basis, it hasn't gone over 1% between September and March. In fact, the government owes suppliers, some of them might be listening to us tonight, the government owed suppliers over 420 billion shillings by the end of March. Job creation, that's another red flag. It's had a marked decline. We only created about 45,000 new formal sector jobs in the last year. And in fact, once you account for inflation, most households in this country, most of us, were poorer last year than we were in 2019. So then, given that backdrop, where do we go from here? We'll be exploring some potential answers with our very able panelists tonight. Stephanie Kimani is an economist. Kwame Winner is also an economist. He's also the CEO of the Institute of Economic Affairs. Definitely worth looking at the work that they do there. The handle is at IEA Kenya. Give them a follow, look at their work. It's always quite interesting to read. Let's start with a very broad question to my panelists, to Stephanie and Kwame. Stephanie, I want to start with you. That broader question of why the private sector is not growing as rapidly as it has at some points in the last decade. Our productivity is also heading in the wrong direction. From your perspective, what are the main policy drivers that explain what's going on there?
Thanks, Shaman. Such a great intro. Majority of those questions have been answered. But anyway, let me answer the questions. In my view, the slowdown in private sector growth and the decline in productivity we are witnessing in this country isn't just cyclical. It's more systematic and a symptomatic issue based on the deeper structural and institutional problems that we've been facing over the past couple of years. Now, just to paint a broader picture, even with well-meaning economic policies, there is no real momentum that can be achieved when public sentiment is weak. And that's very important to me, public sentiment. Today, most businesses and households are operating under a cloud of uncertainty and fatigue. Consumers are more cautious, entrepreneurs are more, risk-averse, and investors are skeptical. And this skepticism isn't rooted in just perception. It is the reality that we are facing. And of course, we have to appreciate the fact that the private sector, specifically in Kenya, has been hit from multiple sides. The first one being around policy unpredictability, which has been one of the biggest drags, I've noted. Over the past few years, businesses have faced abrupt tax increases, ever-changing compliance requirements, growing pressure from revenue authorities. And instead of incentivizing investment as well as scaling, the environment has pushed many companies, corporates, MSMEs to either shrink or stay informal just to simply survive in this economy. Another major constraint I've noted is around the access to credit, like you've just stated clearly. Interestingly, since last year, monetary policy has been accommodative, with the central bank lowering CBR just in response to that lower inflation you mentioned, as well as stabilizing macro indicators. But that shift hasn't translated into a lending recovery for the private sector. And this is because banks remain deeply cautious. Many are still sitting on very high NPLs, especially from sectors like trade, construction, and agriculture that were battered during the pandemic and haven't fully recovered. And as you rightly put it, we have the pending bills issue, which has severely impacted contractors and also tenderpreneurs who largely remain quite small. As a result of all this, banks are directing that capital towards safer assets, particularly government securities, and away from these riskier quote-unquote borrowers. So even though we are seeing that credit is technically becoming cheaper, especially after monetary policy has become more accommodative, we are noting that the credit in itself is becoming less available to those sectors that need it the most. And what I'm saying isn't just theory. And as you've correctly put it, private sector credit growth, as published by CBK, remains in single digits. and even in contractionary territory as from late last year and early this year. So in my view, this is just a classic case of a broken policy transmission mechanism where we're noting the macro signals being more supportive, but at the farm level, the taps are still running dry. And this is particularly damaging for those MSMEs, as I've mentioned, because they're the most sensitive to credit constraints and yet have the most potential in terms of creating jobs as well as innovation. On top of all this, there's a frustration around the state being more extractive rather than enabling. And like I said before, it isn't just an issue around economic policies, because I believe this isn't an issue, in my opinion, around a poor economic design. It seems to me that it's all about a political economy that rewards access over effort. What we've noted is that government procurement is still plagued by opacity. Major infrastructure projects are quite flashy, but often lack economic justification. And while that tax net widens, the benefits of that public spending isn't felt evenly across the board, and this undermines both trust and productivity. So in my opinion, it's very hard for any business to invest or expand in this kind of environment where fiscal pressure is high and regulatory policy is unpredictable. And that social contract, again around perception between that state and the productive economy, is clearly constrained, and that's impacting overall sentiments as well as consumption and investment.
We're going to try and get Kwame back on as a speaker in just a moment. A couple of technical teething issues we're trying to clean up there at the moment. We've also been joined on the speaker panel by Dixon Magacha, a regular on these conversations. Dixon, I'm going to put the same question that I put to Stephanie to you. Questions around the private sector here in East Africa, right? It's not growing as rapidly as it should. There's quite a significant slowdown. We've seen better performance in specific years over the last decade. Productivity is heading in the wrong direction, as the central bank governor, Dr. Kamal Thuge, noted sometime last year. From your perspective, Stephanie has listed a very long list of issues here. Banks are still relatively cautious about lending into the economy. The monetary transmission, she argues, is essentially broken. It's not working as it should. But also the wider macroeconomic environment in which companies are operating in is pretty constrictive to growth. It's essentially a disincentive to growth. I presume you agree with the line of argument.
Yes, first of all is to give you thanks and Mwango and the listeners who've joined us today. In brief, I would say she's painted the perfect picture of where we are. I would just maybe try and add some color to that. Number one, I think we came out of, if you look back over the last decade, I think the first 5 parts of that was a situation where we had huge fiscal deficits that were being pushed towards building infrastructure, and that led to rapid debt creation, especially if you look at the area between 2018 and 2023, where we're adding close to $1 trillion a year in terms of debt. Now, the policy narrative then would have been, we need to invest in infrastructure, and then this will sort of debt that is created. And from that, then you could have economic growth. But on the back of that, once we had stretched this and we were going towards 70% deficits, we had the twin crises where, number one, we had the COVID crisis, which obviously led to shutdown, and then we had to do the policy stimulation, whether it's cutting taxes and running even larger deficits for a couple of years. And at the same time, we had this chronic drought situation that lasted like 4 years. So we came from a situation where we had run the economy hot for a while. Then at the point when we were supposed to actually get active in consolidation, then we go to COVID, and then we have drought, and then we roll over into 2023, and we're smack in a huge crisis. At that point in time, I think the policy choices of the new administration that came in were the fiscal deficit was obviously the priority at that point in time. And that had to be cut. But that can be cut by 2 ways. You can either raise taxes, a bit of both. Because of our 5-year political cycles and the ambition of most politicians who think everything is easy, if they feel like they have this efficiency drive that could come in and fix a few things and everything else would work and fall in place. And this can be evidence from the sort of medium-term policy budget statements that we were seeing, which by the end of the administration would have been raising about 5 trillion plus in revenues. On the basis of that, then you come in and plan quite an ambitious spending plan. Now, the ambit of that is that we were not able to raise the taxes we promised, but at the same time, we didn't cut the spending. And to manage sort of expectations of IMF and the budgeting process we had, then we had to institute these high sort of taxes and new taxes to try and drive the narrative toward raising the revenues to uncut the deficit. But that, again, has failed because the economy was quite weak, at this point in time. And once the revenue side was not matching, I think we've seen slide back towards the borrowing. But happily, when the economy is weak and you try to raise taxes, I think our policy analysts will tell you, running the risk that you might actually fail to achieve any of those objectives. So at this point in time, I think the reality has hit that the tax levels be stretched we saw the year-on-year tax increase is running below the nominal GDP level, obviously showing that we might be above the curve of where would have been the ideal tax position that we should have been raising. Because of this huge administration and drive towards, again, we've seen a preference for guys to remain in the informal economy and try and make small, try and stay out of the ambit of the tax man. And that by itself is one of the bigger problems. When the economy is so informal, it's harder to raise taxes, and then it's also harder to create jobs. So then you have this segregated and franchised businesses that can barely survive it. At the same time, they're not able to raise credit. So it's just morphing into this huge mess where sort of headline growth number, and that's still being driven by public investment. Whereas at this point in time, you're supposed to be moving the lever back to the private sector. Yes, you've lowered the cost of credit, but banks still have to find the people who are able to borrow within the parameters, and that's just not happening for them.
We'll come back to the tax question in a bit more detail. But Kwame, I want to come to you on the same question around the constraints around private sector growth, right? Because that's really the beating heart of the economy. It's everything from coffee farmers in Moranga to guys who are growing barley and wheat in parts of Wasingishu to guys who are raising goats in some random corner of Kajiado and so on and so forth. The private sector is simply not firing on all cylinders. And I guess one way of essentially looking at the growth that we've had in the last decade is that was supercharged by a lot of debt. That sugar high was eventually going to come down at some point, right? You're going to crash and get out of it. But how do we get the private sector firing on all cylinders again?
For me, the story of growth in Kenya is a 30-year story, starting in about mid-90s when the transformation or liberalization began. And then if you split that 30 years into two strict 15 and 16-year shifts, two things. First, misspecified fiscal policy, where in the early years, because of that, after 94, it was very tight. And so there was government underinvestment. And we understand why, that debt overhang and stuff like that, which is what we will be going into right now in a short while. Started. And then later when the economy started to recover, which by coincidence, but people attribute entirely to President Kibaki, it had an external orientation where exports were growing much faster than GDP growth. And that provided quite some impetus for some of those things, and it was really sustained. When government started to borrow money, and this, of course, the orientation started to shift actually, even before President Kibaki left, around 2013, when government was borrowing money under this infrastructure drive, which was supposed to be the new growth leader. Build infrastructure, and then everything else would follow. The orientation shifted from an external one to actually an internal one. And what that did was affected business investment, partly because it affected the competitiveness of Kenya's private sector, especially exports out there. But one of the things that it did in response to the fact the government was borrowing a lot of money, and one of my colleagues already mentioned some years a fiscal deficit of about $1 trillion per year. One of the things that happened was central bank responded to that flush of cash by trying to raise interest rates. What that did was made the Kenya shilling too strong. It affected business competitiveness, especially for exports and Kenya's manufacturing after that. And you started to see Kenya's manufacturing, which was at 14% when the century turned, is now at barely half of that. Of course, it's bigger in nominal terms, but as a share of the GDP, it's actually much, much less. And most of its impetus actually came from external competitiveness. That, of course, made the shilling quite strong. But the point is that while the Kenya shilling was strong, it's something we'll see when we discuss the taxation part of our discussion today, is import grew for a while, but export competitiveness, of course, was just affected. And while imports, which is basically the import of machinery, which helps with those exports, should have happened, it actually didn't. Because if you can import machinery for manufacturer, but your currency is too strong, it means that you're losing competitiveness. And it's a condition that actually persists to today. Kenya still does have that orientation hasn't changed. And this is a small and open economy. So this is not an economy whose monetary for fiscal policy alone will determine conditions under which growth and sustainable private sector growth does happen. So basically that's it. And so we are where we are today, but on the whole, I think the competitiveness that is required of the Kenyan economy shattered. The fiscal expansion that happened did not generate new efficiencies. So we are stuck in this conundrum. But of course, there's a lot of debt to pay. And I think we've reached the fiscal constraints. Basically, last year's generational riot protests, while many people interpret them as political events, in our view at the Institute of Economic Affairs, they actually established the benchmark and they established the political economy constraints for how much more taxes can be squeezed out of this economy. If you look at the last 5 years as well, I'll speak about the inflation question. Inflation is low, really. But our view is inflation is not low because of success of monetary policy. Inflation is low because demand is completely flat. And that by virtue of the fact that the Kenya shilling is strong, but export growth, even import growth, is actually much, much lower than it was the years before. So that's the situation. So it's a tough one. I agree with one of my colleagues, Stephanie, who spoke for saying this is not a cyclical problem. Kenya has a long-standing growth problem, suggesting to us that both monetary and fiscal policy was misspecified. And it's a generation-long problem.
We'll get into the details of that in just a moment. So just to give our listeners a bit of context around the debt service problem that you alluded to there, if you think about the amount of cash that we have to pay out just in terms of just interest alone, right? Principal we can roll over, but just interest alone, both internal and external. The figure for last year was around 995.8 billion Kenyan shillings. The estimate this fiscal year that we're in now, fiscal 25-26, is that we're going to be spending 1.1 trillion shillings just on external and internal interest service between July 2025 and June 2026. And that figure is going to remain roughly at that level through to 2029, at least according to current estimates that we're seeing at the moment from Treasury. I want to get back to that question around taxes, because some of us might have seen the data coming out of the Kenya Revenue Authority. They released their assessment of full year tax revenues earlier today. Lots of interesting content in there, especially for public finance nerds like myself. And one of the things that stood out immediately for me was the fact that the revenue target miss was there, it was present. Pretty much everyone who had listened to the revenue target estimate when last year's budget was being read of around 2.9 trillion shillings would have seen that number and thought, yeah, that's not going to happen. And eventually they missed it. The revenue is going to go to the exchequer is about 2.3 trillion Kenyan shillings. It's a year-on-year increase. If you look at the exact same number compared to the previous fiscal year, it's an increase of just about 100 billion shillings, which is, in the larger scheme of things, very small. Kwame, what stands out for you based on the data that KRA put out today in the performance of those various tax categories? Because in some instances, like there was a line they put out around the performance of excise taxes, and they specifically said, let me see if I can really scroll down very quickly to that particular segment here. Domestic excise tax, there we go. That tax had a performance rate of around 97.2%, but there was a decline in revenue remittance from manufacturers of beer and tobacco products by 13.9% and 8.9% respectively, which tells us something about consumer spending, doesn't it?
Yeah, it's true. So the first thing that you have to notice, and I think you suggested it, so let me just repeat it. Repetition is emphasis. So yes, the first targets last year were 2.9 trillion. Completely ambitious. My view is that even with the finance bill passing, because that's what the excuse is, 2.9 trillion was not an amount that could have been squeezed out of the economy. It wouldn't. But let's leave that aside. In addition to that, throughout the year, there were 3 supplementary budgets, which adjusted the revenue target from 2.9 back to 2.3. And therefore, KRA states that it reached the target of 2.3, 100.6%, just barely reaching it, but it was adjusted downward thrice. So that's the first thing we need to notice. And if you look at it nominally, because the KRA presents its targets nominally this year against last year, one of the first things you realize that total revenues grew by just about 3.8 or they're about 4%, which is equivalent to inflation. So if you strip out inflation, revenue targets this year and the last financial year are basically the same amount. So one of the other things that therefore drove the deficit is that the spending though went up. So that's the thing. And it's telling us this very straight place that I think my colleagues have spoken about the Laffer curve, the political economy constraints is right there. The signal is right there. Whether it will be heeded by Parliament and the executive is a different matter altogether. On the other side, there's the KRA itself released exchequer revenue, which grew by 4.5%, domestic revenue 4.8%, agency fees by 34%, but of course, that's agency fees, then customs revenue by 11%, partly flattered by, I think, the exchange rate as well. But on the whole, because the currency was a bit strong, it allowed for more exports, but even then, export volumes on their own in total did not grow by much. So I think here is a lesson. And if you look at this and try to superimpose this result against what the new revenue targets are, which is 3 trillion and above, you're still going to ask yourself, what's going to fix between now and then? So there's this pattern of overestimation of what the revenue potential is, which comes short. And my fear is it usually shoots up the deficit because the borrowing, obviously, once the spending is anchored on a certain figure and a certain revenue figure, then the government uses a supplementary budget to find sometimes to trim expenditure, which tends to be development expenditure side, and then at the same time expands the borrowing quotient. And I think that's going to be the lesson this year as well.
Stephanie, you're still on that tax question, because looking at the data from KRA, if you just look at the personal income tax hit, that went up by around 3.3%, right? So to use the same framework that Kwame has very elegantly given us there, if you just essentially strip out the effect of inflation there, average inflation is off 3.8, almost 4%. That's less than inflation. So it's almost borderline a decline at best in terms of the amount of personal income taxes being collected by the state. But what else stood out for you here with these specific numbers? Because the revenue miss, I think, for all of us was expected. Was there anything that stood out?
Yeah, like I mentioned before, consumers, the economy is going through a general fatigue. So I was pretty impressed that they were able to exceed their target. But like Kwame has put it correctly, this was a downward revision from before. Let me just go back. With respect to even the quote-unquote overperformance, it's, in my opinion, is not necessarily as a result of the economy is doing well or better, but it's just clear that this is as a result of enforcement, an increase in that enforcement, where KRA has leveraged on various data analytics, digital surveillance like e-teams, just to widen that compliance. So in my view, KRA is just collecting more from that existing base, rather than seeing that meaningful tax growth on new or growing enterprises. And like you've mentioned, from the pay and corporate tax collections, yes, the growth was small, around 3.3. That's around inflation. And to me, this is less impressive and confirms what I already know, that formal job creation remains quite stagnant and also farm profitability is under pressure. And again, as you've also mentioned, around the beer consumption as well as tobacco. Tobacco and beer, maybe the audience may appreciate this, tend to be quite price inelastic. And this just means that they tend to be more resilient to any shocks. So when you see a decline in remittances from these producers, it signals to me there is an issue around that real disposable income, and it's just a broader issue around consumption. So there are concerns there. I have said this before in various forums, even with Mwango, that my personal belief is around growing that tax base. But there's no way you can be able to grow the tax base if you don't invest in private sector competitiveness and lowering the cost of doing business, as well as reducing that policy and predictability, which is keeping firms from scaling. That's the only way we can grow the tax collections more meaningfully and sustainably moving forward. So yeah, those are my thoughts on that.
Absolutely, I agree with that. And ultimately, one of the other things that often comes up with these conversations, if you're going to try and make the argument for it, we need to expand the tax net, right? If there's no trust between the governed and those who govern, the ability to implement those policies obviously becomes quite problematic. Dixon, I want to come back to you on something that Kwame said, because we keep having this gap between what our effective revenue collection on an annual basis is. To use the example from last year, when the initial budget plan and the budget policy statement, I think, came out around April, they were talking about this bombastic figure of 2.9 trillion. What eventually they were able to collect was much, much lower than that, around 2.3 trillion Kenyan shillings, just based on the data that KRA has put out today. And when you're looking at this from the outside in, because we've had this revenue overestimation problem for a very long time, it doesn't do us any favors when it comes to the credibility of both our fiscal policy and our monetary policy, does it?
The issue with this revenue myth, I think, came with the new constitution. And I think one change that happened was that the budget process was made to start immediately after the new budget is passed. I think by October, we usually would have the first estimates. And therein started the problem, because at the point you give in the budget estimates in October out of the June budget, you obviously assuming that the number that will start from July the next year would have been the number you're projecting for 30th June, 10 months or 8 months away at that point in time, or 9 months away from that point in time. And most of the time, because that number usually is 10-15% overestimated, ultimately what it means that the next budget that you plan in, the starting point is already elevated, and then most of the time we tend to have maybe a 10% increase from that number. Such that at that point in time, if you're looking at the actual number that was met the previous year, you're already trying to project a 25% growth in tax revenue. And if you do this every year throughout, so obviously what you're doing is that you're building this medium-term budget policy statement, builds it to that, but has a 4-year or 5-year horizon. But all those numbers again, starting from this elevated 10-15% point higher, and then you have all these estimated goals, and they are already robust. And part of this, I think, again, comes down to how we organize our political system. Most of the plans that we have are always surrounding each administration trying to have, whether it's legacy projects or trying to front load all the infrastructure development bids that they want to do because they have a 5-year cycle and they feel like it must be the ones to implement them, as opposed to implementing really long-term, the 20-30-year strategies where you'll be, say, strengthening the efficacy of the budget process, the administration trying to reduce the cost of business, some of these soft things that the public may not see but could build a much stronger foundation for the state to sit on, are really missed, because everyone wants to build their own roads, wants to build their own rail, wants to build all this visible infrastructure, which is what they'll tell the voter they did, as opposed to saying, look, a real foundation of where my finances sits. If we took 5 years to strengthen the efficacy of how we budget, get a more realistic outlook and path forward of where you start from, probably you may not have the PR to sell that narrative to the voter. But if you did this over 5 years, at the end of that period, I think you would see a more sustainable model of growth. And maybe from that projection, then you would actually see the economic growth coming through. Saying, before, we did succeed, but we were coming from a point of very high interest rates, very little public spending. Then the debt levels were not that high. So it was very easy for Kibaki to jumpstart the economy by cutting CRR from 10 to 4%, and all this liquidity unleashed in the market. And the market was quite weak then. The demand was quite weak. But then there was a shift from the public to private sector. I did investment in the factories, boosted the export side. And once the economy was slightly bigger in 2013, we looked around and said, oh, look, we have capacity to borrow. The best economy said we have very low debt levels. I think we can now build the infrastructure, which then will reduce the cost of doing business and build the next phase of development. And I think that for the last 12 years proven not to work. The challenge is, at this point in time, we're still doubling down. We're still thinking of doing SGR. We're still thinking, oh, let's build roads, as opposed to thinking maybe if we budget it better and stop spending money that we're borrowing, maybe that is what would fix the issue.
Indeed, and that is the wider question at the moment, because economy, I think you've made this point multiple times over the last couple of years, that it's imperative to drastically reorganize public spending, because we simply cannot rely on the current model that we've seen in at least the last 3-4 years of simply saying, we'll raise the marginal tax rate here, the marginal tax rate there, and that's somehow magically going to allow us to have a magic pot of gold to allow us to grow our way out of the crisis. And the counter argument often here from government guys is we have a lot of these fixed costs, salaries, pensions, debt service, and so on and so forth. So cutting spending is quote unquote difficult. But is that really the case based on the data and the studies you've done at IEA?
Yes, it's true that making cuts is a difficult thing, but it's not impossible. And I actually think that, so look at it in this way. If you look at the allowances system in the public sector, so the entire public sector, based on the cabinet secretary's declarations, is about 78 billion per month paying public sector workers in the core public service, 78 billion shillings per month. But if you decompose the amount of money that goes back to allowances, it's another 40% on top, right? And from allowances. So Kenya's public sector now, these are just estimates based on estimates for this year, is about close to 80 billion per year per month in wages and close to 39 or 40 billion in allowance from the same public sector. So those are allowances. In other words, these are the costs that are not fixed. And I find that just completely unreasonable. There are public sector workers who buy suits paid for by government so that they can present the budget. I kid you not. So basically, if you go through and decompose what the allowances system in Kenya is, and if you look at the Salaries and Remuneration Commission, which is supposed to do this control, to be honest, has failed, we have 300 and something allowances in the public sector. Different forms of allowances. The first wages conference that they called was, I think, in 2016, maybe 2015. And I remember I was invited. The president was there and spoke very actively. So it doesn't matter what the collective bargaining agreements do. If people know that you earn 80,000 shillings, as some interns earn, medical interns, but by the time all your emoluments are actually totaled, you end up with 280, then you cannot control, because that part of it just presents a lie to you and I, the taxpayer, that actually public sector people earn low wages. It isn't, if you look at what that is. So if you start on that side, definitely. I'd rather we gave every public sector worker a one-time jump in their wages of 50%. I'd be willing to take that. And then you simply adjust wages so every 3 years or whatever number of times. Because what we have now is a racket. The allowances system in the public sector is a racket. So let's talk about that first. The second point comes to the question of workers. If you look at the estimates from the Office of the Auditor General, looking at the number of workers, I actually don't believe that the government of Kenya has 1.1 million workers. As in really live blood and flesh people. I don't believe it. I really don't believe it. But that's what we are told exists. And I think the payroll fraud problem in the public sector is another one. So here I'm not even talking about those things that people talk about, procurement efficiency, which is the third way in which government could actually gain things. Those three are problems that if you look at it, the IMF program that was just surrendered tried to consolidate the Kenyan public sector payroll into a single system, just building a database of all public sector workers. It failed. And so Kenya has these three things. One, what they call the old legacy one. There's a second one in the public sector, and there's still public sector workers who get paid on cash for window and stuff like that. So that system alone and the inefficiencies of it, it's a political economy problem. There are people who don't want it solved. And if it gets solved in a single day, the efficiencies that would come out, forget about, I'm not even talking about anybody taking a pay cut. I'm just talking about that. No, there's scope to actually save a lot of public sector money by simply reorganizing how the public sector onboards workers, pays them, and ensures that they leave. That's just me. So those 3 points alone, I am sure in my back of the envelope calculation at the Institute of Economic Affairs, the public sector could save 400 billion shillings a year.
And just to give you an illustration of the sort of abuse, for lack of a better word, of the payroll system in the civil service, essentially, there have been instances, for example, at KFCB, the Kenya Film Classification and Censorship Board. There's an entire row going on, and this is actually being prosecuted in court at the moment, where the former CEO of that institution, in his first term, his monthly salary is around 350,000 thereabouts shillings a month, and he essentially asked the board to adjust it pretty much by a factor of 3, from 348,840 shillings a month all the way to 1.1 million shillings a month, despite the cabinet secretary in charge of that ministry at the time writing to the board multiple times. In fact, there's one letter being cited here on the 30th of April 2019 telling them, do not implement this increment. And regardless, despite that advice, the former CEO of KFCB proceeded to serve his full term, second term anyway, of 3 years. And in that period, he was drawing that revised salary at your expense as Kenyan taxpayers of 1.1 million shillings a month. So these are the sort of things, if you want an illustrative example of the sort of waste that we're talking about in the civil service, that's just one. Dixon and Stephanie, I guess the bigger follow-up question to that question around where do we cut? And how do we cut? Because we can sit here and do the math, right? We can say procurement is one easy place of doing it. There's been talk about a treasury single account for, I think, the last 10 years, if not more. And there's been very little progress on this. The obstacle to doing this is mostly one of political and institutional inertia, isn't it? Or is my reading of that wrong? Dixon first and then Stephanie.
Okay, I think the challenge is always the special interests and trying to muddle things along. And like comment says, if you know you have ghost workers, if the allowances that civil service are paid are over the top, but if you know your procurement processes have issues, why are we not able to move the wallet on this? I think ultimately it comes down to special interest. To me, I've always said the best way to solve this would have been working with macro aggregates. Either we put a debt anchor in the constitution and the deficit above, say, 2% or the figure like that is unconstitutional, so you cannot budget anything above that number. How you distribute it is up to you, whether you have to fire workers, don't build roads or do whatever. I think that might be a better way to work backwards. It's some sort of maybe close to zero-based budgeting, but at the end of the day, because we have all these interests and the political maybe cost of trying to tinker with that becomes excessive, whether through deep state or just the reality of how the government has always run, and whether you might get to vote from the civil service or whatever it is. And the civil service, we know it's entrenched and it's hard to change the bureaucracy. Ultimately, to me, has always been, if you've come in as a new administration and your budget was, say, X number last year, why not just stick to that number and tell guys, listen, we're going to produce this number. Figure everything you want to do, it has to fit this number, whether you have to fire people, whether you have to do whatever. And from there, you then get to choose where you want the efficiency to go. But as long as the aggregate number is anchored, then to me, I'll be okay. You might still have your efficiencies, you might still have your graphs, but at least that will stop blowing out deficits, as opposed to having all these overarching things. We're going to have a single treasury account, we're going to do e-procurement, we're going to increase efficiency. But at the end of the day, nothing really gets done because of government bureaucracy and special interest in there. And then that means that gets rolled over into the next year and the next fiscal year. I think we need a solid debt anchor. We did have one in the sense of debt to GDP, but since that was blown up and the law was changed to change that from a nominal number to a fixed number, which then was breached, then we moved back into a floating nominal percentage, which is in the future because of we're above that now. That's not a functional debt anchor. I think we will need to have a debt anchor that's probably based on either revenues collected on actual basis as opposed to projected, and then you add a small nominal number on that, or a fiscal deficit percentage that's anchored in the constitution. And if for you to breach that, you might need to have a very high threshold of parliament, say 90%, or for special cases like COVID, that might need you to breach that, maybe something close to what German has, which then means that the number you have absolutely to budget with is anchored, and then you have to live within that number. And if you think about it, excessive debt actually should be constitutional, because if you run such a huge deficit like the last Jubilee administration did, moving the debt from 2 to 10 trillion, the end of it all, once you hand over the government, the next government cannot do anything else beyond just managing that debt. What mandate are you giving them, and versus to what are they selling to the public? So ultimately, excessive debt should be constitutional if you think about it.
Stephanie, your thoughts?
Yeah.
Are you also a fan of that idea of we should just have a fixed fiscal deficit target? It's pretty much like when you lift it past, I don't know, say 3 or 4% of GDP, you must get parliamentary approval.
Actually agree. It's actually one of the thoughts I had, that we need to shift towards a rules-based fiscal strategy. as opposed to this strategy where it's based on discretionary measures. We do it as and when we please. I do not like that. I agree with Kwame. We have the cutting of non-essential recurrent expenditure, which everyone has spoken about time and time again, the payroll reform, as well as the procurement reform. Those four, including that rules-based fiscal strategy that Dixon has stated, in my opinion, can work. But I also want to bring another angle in terms of how this will affect the tax question, the tax problem. And I honestly believe that morale in paying taxes is deteriorating or has deteriorated over time. And this is because the public is seeing the government being lavish in terms of their spending. They have bloated delegations moving left and center. And obviously there seems to be misplaced priorities. Even for me as a taxpayer, I would even struggle to figure out why should I comply with these tax reforms that are being placed. As I mentioned before, they are meaningful, as in they're placed, they're meaningful, but why should I comply if this is where my money is going? And I believe without this strategy in terms of cutting spending, we will continue to see a mindset for consumers and even businesses alike that will fuel that informality of our businesses, tax evasion, as well as that resistance to even those well-designed tax policies.
Stephanie, I want to put you on the spot a little bit because I know in past conversations, there's a statement you've said that's always stuck with me. And this is with respect to how government is borrowing cash in the domestic market. And one of the things you've said is if you're sitting from the government side and you're borrowing cash, stop accepting expensive money. And I have in front of me, this is a long running spreadsheet from the central bank, goes all the way back to, I think, 2004 plus. And some of the T-bill rates I'm seeing here are absolutely envious. 1.5% on a 91-day T-bill issued in March 2004. 182-day T-bills at 2.4%. What's stopping us from getting back to those levels?
Aren't we getting back to those levels? We are now at single digits, aren't we?
There's a bit of a gulf between 8% and what are we doing now?
I would also want to imagine and also want us to imagine that this economic situation then was very different from what it is now. But we are in single digit territory. So yes, we're in single digit territory. Things are different. But I would imagine the reason why even investors are still going into the investing in government securities is because there's limited investment opportunities elsewhere. So they're willing to park their money with the government and live at single digit rates as opposed to letting their money just sit out and do nothing. So yes, I believe that trend will continue, maybe not towards the 1%, but within single digit territory, so long as there's no alternative investment option elsewhere.
Indeed. And just to put a bit of color on that, the T-bill auction for this week results came out a little earlier today. Usually the government comes to market, they're looking to borrow around 24 billion shillings. The market weighted average rates that we're looking at today were anywhere between 8.47% and 9.72 on the 91, the 182-day and the 364-day T-bills. Away from the public sector side of things, the sort of tax policies we need to start thinking about as we get into fiscal 26 to 27 and of course beyond all the way through to 2029. What sort of tax policy changes should we be thinking about between now and then? Because the medium-term revenue strategy has some interesting ideas in it. And by their own admission, the finance ministry is saying, look, we really do need to cut some of these top marginal rates of tax. We need to lower VAT, for example, perhaps by 200 basis points, lower the top rate of corporate income tax, personal income tax, all the way from 35%, bring that all the way back down. But beyond that, what else needs to be done? Kwame, let me start with you on that question.
Please allow me to go back to something that my colleagues have spoken about, and I have a different view about government borrowing. So look at it last year, or just a year before inflation started to fall, in my view, precipitously from about 8 or was it 7, all the way back down to 3%, right? So the spread between interest rates and inflation, the spread was built about 4% between what the interest rates was and the inflation. Today, because inflation is so low, and while the interest rates have dropped back to about close to 9.7%, actually the real interest rate is actually higher now than it was last year. That's not conducive for investment, obviously. Who is going to invest under those circumstances? So if you look at the real interest rate, which should actually be the guide about whether investment is going to happen, we are still in a territory with inflation being as low as it is, such that it's actually still more rational today to keep money with government than actually to lend it out to businesses. And so that affects business investment. So that's one. But that issue aside now, let me come to your question about taxes. We at the Institute of Economic Affairs, we're usually very careful with our language. We are not believers in the view that a rich government or that public affairs should be arranged to maximize tax collection for government. We don't. We actually don't believe that government should actually have a policy of maximizing taxes. We understand why the KRA does that, because the KRA is an agent for collecting and actually receives a commission based on its collection. So we understand its incentive. But we don't think that the public should be debating that how do we ensure that government collects higher taxes. I'm not too sure that in any school of economics that is taught as a good policy. With that idea in mind, why? Because taxes have the effect of creating structural damage in markets. So when you collect a tax, you don't just collect revenue, you actually shrink a market and create a deadweight loss. So if that teaching is true and evidence is there that it is true, our view is there's something called optimal taxation, which is low tax rates spread over many more things, which brings me now to what I should. Government lacks credibility because the taxation policy, the strategy that we had by now should have had VAT coming down to 14%, corporate taxation coming down to I think about 25 or 27, but it should have been much, much lower than what it is. Income taxes, pay as you earn, actually should have been up 34 at the top rate. That's not what we have. So it's difficult to actually say that the tax structure that we have even follows government's own policy and its rationale. So what should we be? I think the government of Kenya, and I say that generational riots, we might interpret it politically. Our interpretation economically is that it's telling us that there's a limit politically to how much more taxes government should. Meaning that the government of Kenya should not be going to Japan and saying that, oh, Japan has fantastic trains. Therefore, to get those trains means we need 40% of GDP as Japan has. Or the next time you travel to Sweden, say that, oh, Sweden has fantastic air, they've got good roads, they've got this and this, and because we wish to have that, let's aim for 45% of GDP. It's not going to happen here. Why? Because the living conditions to begin with are so bad that once you start taking higher tax rates or start raising marginal tax rates, you're going into people's food. You're taking money that people should place on food or the investment that they should make and stuff like that. So we think that the development model for Kenya, whether government is conscious of it, is one has to be one that takes 18, 19, 20% of GDP as taxes and use that efficiently in order to feed whatever development agenda we come up with. So I think a flat tax is something Kenya should seek. A low rate for VAT, in my view, should be aimed at in the medium term to get it back to 10%. Yes, 10%. There's no magic in 16% when it's so much cheating as what we have today. There's so much cheating on VAT returns and a very complicated system. And of course, there are people who are wedded to it. They tend to be accountants as well because that gives them work. And that's fine. They're entitled to earn their shilling. But I think that the model of taxation that we have is far too complicated.
Kwame, just to interrupt briefly, because with respect to VAT, if I understand your line of thought to be essentially, let's lower the rate, have it as simple as possible, do away with a whole bunch of these exceptions that have now come back into the VAT Act over the years, because that eliminates that entire problem of the complications around compliance, the cheating, the fraud, and so on and so forth. Do I understand you correctly?
Yes. If you get it to 10% and spread it on anything, so we don't have the complications of VAT exempt and zero rated and the parliament moving them based on lobbyists every so often, or raising it for one item and not another, and they're both inputs into a third item. So basically, if you simply make it, we can call it a sales tax. Many people have hatred for that, and simply place it at a level. The lower, the better. Spread it on everything else. And if you think you need to resolve certain distributional questions, say for instance, you don't want bread or you don't want something, then all you do is we have a social protection system. You identify the households that are most vulnerable and send cash to them. But just to prevent VAT returns being the biggest debate between the revenue service and your usual businessman, so that you have to get lawyers to go in, discuss your VAT returns every year. And as we all know, the embarrassing thing that happened this year, was it in February or March? No, perhaps in April, when department had to completely cycle away, right? Half of the team in the VAT department or one of the tax departments because the cheating was just enormous. And so we lie to ourselves that we have a system and we speak very highly of it, and actually it's raising that. So if you simplify tax systems for everybody, make businesses respond, and then let tax growth come from regular economic growth, not shifts every single year in the tax code. That's basically it. And the tax code in Kenya, in my view, actually is so big. I have colleagues who've measured it. The income tax code alone is upwards of 600 pages. And you have people on an income per capita, $2,800. So you have to read the entire tax thing to respond to it. Simplified taxes, and I dare say a flat tax. Bring it all down, fine. You can raise it wherever you want to. If you raise it to 40,000, anybody above that, I know it'll big shift. Anybody above that, 25% or even 22%, as we've calculated the Institute of Economic Affairs, make it bang down to 35,000 shillings and collect those taxes and allow everything else to rise on the basis of tax and economic growth, not necessarily by shifting tax codes every year.
I don't think I would have any disagreements with that approach to tax policy. Dixon, you want to win on the tax question before I bring in my follow-up?
I have a slightly different take on this, and I understand the comment scenario that is put in, which is quite ideal. My worry has always been that, given that our economy is very informal, and there's a lot of folks in the Jua Kali who do relatively well, and the consumption taxes they pay, they don't pay any other taxes, and maybe it's not easy to measure their income given the structure of this informal economy we have. I've always felt like the VAT level or the sales tax, these consumption taxes that we have should be retained. My worry has always been on the formally employed workers, the ones who pay the bulk of this. Maybe it's 120,000 people. If you strip down to the actual income that was paid by payee. And I feel it's quite unfair because at the end of the day, we do know the black tax in our system, whereby the formally employed guy will probably be spending another 20-30% of his income for maintaining whether it's sibling, parents, and all these other services. And then most of the time you'll find that probably he has to pay for his own education because the public sector education is not that good. Supplement his own healthcare despite paying the 2.75%. You pay for his own mortgage despite paying 1.75%. So ultimately, concentrating on payroll taxes, I think those should probably have come lower. And we have a slightly bigger shift towards consumption taxes. Ideally, yes, it's a drag on consumption, but I feel it would be more equitable, given that there's a huge number of people in the private sector who, after being just pay that VAT, most of the time they still go back and file zero income tax or just post losses on businesses because they're able to shift expenditure or income. And that then leads to this inequality between the folks who are employed and the folks who are doing business. And they don't want to become formal and larger because then they get to the tax bracket. But that said, I think ideally in the long run, what Gov't proposes is quite rational, should be lot of simple taxes that are well designed, easy to interpret, and fair to all.
There's a question that's come in to my DMs here. There's a listener who's asking, and this is Mugami Nandi, I believe he's talking about this using a UK base of comparison. I believe this should go to you, Kwame. His argument is this: UK VAT rate is 20%. How does that then relate to your proposal to lower the VAT rate to around 10%? In other words, what's the rationale here that would make one rate preferable compared to another? And I know you've covered this a little bit in your answer around the exemptions creep and the exemptions problem that we've talked about a little earlier. But Kwame, do you want to respond to this?
Yes. So first, remember that the economics of taxation states that taxes should best. If basically government is interested in a stable taxation, provide a predictable environment and let taxes grow from growth and not necessarily by having to shift the tax. To talk about the stability and the predictability of tax collections. So if you think about it from that perspective, the kind of tax structure that every society should have is dependent on its industrial and GDP base. So the UK has a huge industrial base, regardless of what people say about Europe. The UK has an industrial base. We don't have that in Kenya. Secondly, the design is such that you actually have Kenya so many exemptions. So for instance, the VAT reform that was done in 2014, when President Uhuru was elected, among the first things he achieved was to actually get us to clean up the VAT Act. The rationale at that time was that while the VAT Act was first passed I think in 1994, as part of the reforms, it had by 2014 come to have so many exemptions that it was completely useless. I think the exemptions had gone to more than 1,000 and it was fixed. The problem is, while it was fixed in 2014, we are chasing that number again. So in less than the 30 years that it took to get, I think, 1,300 exemptions, we're already close to 1,000 in 15 years or less. So obviously it's telling you that the VAT mechanism that we have and the way we fixed is not a good one. The third issue that I think we must talk about is taxation policy is also about a social contract. And so taxes that are levied should be taxes that people are prepared to pay. That's the political part that government persuades people. So if you look at the way taxes are designed in Kenya, and that's part of the reason why I'll end here, but let me respond to my colleagues mentioning as well. Look, if you have a fixed flat tax, obviously you are moving taxes away from income because income taxes discourage work. However, if you move it towards consumption, that's a better thing because if people don't consume, what do? They save, which is still useful for economic performance as opposed to discouraging work. So on a relative basis, you should move taxes from it. We have a peculiar system in Kenya where most of the taxes come from pay as you earn, which means the burden falls on work, discouraging work. And that's part of the reason why actually we have a big informal sector as we do. Definitely, you're right. It should be moved towards consumption and away from labor. But there's no magical number around what a VAT should do or any tax. All you need to ask is, what does the economic structure look like? And how do we want to have a predictable tax regime that allows for those revenues to grow together with the economy without having to create distortions every year as we do in Kenya?
With respect to the question around the social contract, if I'm paying taxes and then I'm seeing those same taxes being wasted and splurged on politicians who are taking junkets to Dubai or somewhere in the Far East or Western Europe or the United States, you're giving me an incentive to not be paying those taxes. Stephanie,
Just mention something just on that in terms of the UK and Kenya, the difference. Just more broadly, I'm not a tax expert, but just the differences in the Kenyan and UK economy, aside from the one being more industrial and us being more informal, is that at least in the UK, the higher VAT charge, the rate is offset through social protection, which we don't have. And so in Kenya, we find that the households, their disposable incomes are much lower. And the real net burden for Kenyans is much higher compared to the UK, given that social protection and the welfare that the UK government provides to its people. So those are the differences. And also for consumption tax, you charge tax where people are spending, and it's better than pay as you earn. Just that.
common counter argument that we hear every time I make the argument of we need to cut tax rates. We've tried this experiment of growing the revenue base by essentially raising the marginal rate of tax. We've raised the top rate of personal income tax, for example, all the way to 35%. Excise tax has been applied to knows how many different things, everything from beer and cigarettes all the way through to mobile money. But at some point, we have to bring it all down. But the argument that I often hear in response is if you lower the tax rates without actually cutting spending at the same time, you're sending the wrong signal to the market. So if you're a foreign lender and we go into the market and we say we're going to borrow $1 billion in a Eurobond, we'll be told, hey, but your fiscal policy isn't making any sense. So what do you make of that argument?
That's true. I think one of the things that locks us in an ever-escalating budget is the idea that cutting is difficult. And if you cut and also if you reduce taxes, especially as part of resolving the question, you lack credibility with markets. But I wonder which market is this that looks at Kenyans today paying close to 1.1 trillion Kenya shillings in interest alone for this year and actually thinks that's a sensible structure, given that revenues are barely 3 trillion. I wonder if that's sensible. But it's true. I think we shouldn't caricature those who ask for taxes to be cut because two things could happen. The efficiency that is gained from businesses performing much better. And that's real. We have manufacturers who actually leave this country and tell you, look, the problem is not just the natural environment, the environment on its own. It's a competitive place. We can find workers, but the tax changes that are just make us unable to not just compete because the Kenyan market is small. If you're a manufacturer, if you want to compete regionally or in other parts of the world, it wouldn't be possible with the kind of tax structure that we have here. So that's one of the other things. So if we talk about tax policy as about funding this year's budget alone, then obviously cutting taxes becomes a problem because you think about, look, we need to fund this year and let next year take care of itself. And that's why you have these repeated raises in the marginal tax rates every year, depending on what magical or fantastical revenue target is being chased for that year. So I'm not going to say that cutting taxes means you leave the business right there. But the point is, if you have a longer term horizon, for investment growth, for business growth, I think getting the tax rate specified, getting the tax rate about right is an imperative. And it is clear that there is no level of taxes that will chase the runaway wish list that we present every year as the budget. You can never get enough to be able to meet the spending needs that public sector workers are able to come up with. All manner of things can be justified. If you haven't done enough every year building expressways at SGR, then there are houses to be built, then there's SHIF and SHA to be done and all that stuff. So whatever it does to business shouldn't matter. So if we care for the solvency of government and everybody who's responsible should care for the solvency of government, and I think a moderate tax rate is something that should be attractive.
Stephanie, do you want to take
Yeah, I
on that as well?
largely agree with Kwame. And of course, it would raise a red flag with credit rating agencies as well as eroding investor confidence when we are coming in and saying, hey, we want to cut our taxes, but we won't be necessarily cutting our spending in line. So we have to cut our taxes, but we also have to cut our spending. But nonetheless, the approach, and this is just very high level, is in terms of the tax cuts being more gradual and targeted. And this should be paired more with just credible and transparent spending reforms. Because again, I'm very particular on investor confidence, perceptions, and all that, and sentiments, because essentially, businesses and consumers are the ones who are paying taxes, for example. So if we do not see that, then we will not feel the need to pay these taxes and feel the need to comply with any tax reforms that are set out. So having that gradual targeted tax cuts paired with that credible spending and transparent spending reforms, I believe that should be the direction, because that will, in my view, show investors both locally and abroad, as well as credit rating agencies, that we are not just abandoning the fiscal discipline that we've been speaking to time and time again, but more or less pivoting towards a more inclusive and productivity-driven model. Again, going back in terms of taxes, if we're unable to cut taxes, we should at least be supportive and investing in ensuring that the economy becomes more productive. And that will be the turning point for me.
I think part of the issue also is the fact that our revenue to GDP mobilization is in the mid-teens. It used to be about 23% at some point, I think, during Kibaki days. So ideally, someone looking inside at the GDP, they will say, okay, you have all these taxes, but your collection is just 15% of GDP. You have capacity to move towards 20, in which case then the narrative then turns, you can't claim you're paying too many taxes, since the collection itself as a percentage of the GDP is not really measuring that. To me, I think it rolls back to the debt anchor. If you know the size of the deficit, what will happen is that you start running primary surpluses, which is you budget all your expenditure within the cash you have. And then once you have a primary surplus means that you're paying down part of the principal debt repayment. And that means you're rolling over less debt. And that then will drive down the cost of the remaining debt. And as you roll over that, the portion of the budget that's going towards interest service moves towards 40%, maybe towards. And once that is spent in the real economy, then that boosts extra taxation, and then that yields up your tax revenue. So ultimately, any tax questions we have cannot be if they're not reducing the central deficit. Ultimately, yes, come back cut spending, and if you try to cut taxes while the tax to GDP is still 15%, it still looks like we are not being rational. Thanks.
There's a question that's come in that I think would be a fantastic way of tying this entire conversation together, because it addresses the question of how do we get out of this? And the question that I'm going to read out shortly comes from Judah Moore. He's a fellow now at CGD based out of Washington, D.C. Prior to that, he was the minister in charge of public works and infrastructure over in Liberia. And this is essentially his question. He says he spent about 6 weeks in Europe, and at every event, when he was asked what African country he would recommend for investment, he said Kenya. And he still believes that Kenya is an investable location. But trust between taxpayers and the government has clearly been eroded. What needs to be done, right, to essentially rebuild this confidence? Because ultimately, yes, it's a technical problem, but at the end of the day, it's also something that has to be fixed in the political space as well. Because rebuilding that trust, all these things that we've spoken about, cutting public spending, rationalizing what is how the wage structure in the civil service, getting things like the TSA, the Treasury Single Accounts done, making meaningful cuts to public expenditure and agreeing that we're not going to be doing this government by Instagram business, and instead actually focusing on the nitty-gritty details of public service delivery, right? That will not necessarily yield fantastic Instagram engagement, but these are the things that people actually need. Licenses that are issued on time without having to bribe someone, things that actually work. That ultimately is this question. How do we get to that point to get out of this rut? Kwame, I'm going to start with you, then Stephanie, and then Dixie.
You'd think that would be clear, especially to the administration we have in Kenya today, because it came into office on the backs of, look, we are listening to the little people who were ignored. And we generally are not taken seriously or taken to be simpletons. And then it's just torn the script that it came in with. So I don't know that this administration can be saved on the basis of building anybody's public trust, but still, I think people must try. So one of the things that it needs to start is we have an administration that's very preachy about, look, guys, poor listeners. So even the thoughts, even the idea that we should listen a little bit more helps. I think people just want the respect that comes with we've heard, and it's not just Instagram and, as you said, X Spaces when it's necessary and buying newspaper articles and stuff like that. To listen a little bit more and to believe, as it showed that it believed that actually you can persuade government to do important things. And even if government does things that are different from what some public or some people expect, an explanation for the reason or his why. Because I think Kenya's administration today, I'm speaking about the one today, comes out as, they're smart, you guys are not, listen to us. We'll do it to you, and one day you'll thank us or not, and stuff like that. And I think that kind of condescending attitude in itself, even while the circumstances are difficult, is one of the things that's most annoying to. So that's it, just build it up here, and perhaps use its best faces. Some of them are more trusted than others, and try to use us to build confidence. Not just with the youth, because people think it's the youth. Actually, even elderly people, and I'm certainly not youth myself, I'm not in the Gen Z, but I think this government, its behavior in general, is just shameful. Denying stuff that people see. So the idea that, no, you didn't see it, I see it's happening. That's one. And thirdly, at least try for 3 days to tell the truth. Start from small steps and stuff like that. That's a question about messaging, the political thing. Because this administration is not lacking in PR experts and all manner of journalists working for government. But when their bosses release statements and half the country doesn't believe it. So it's a difficult thing. So I don't have a perfect answer. But at least for the first, start by treating people as if they're adults and have conversations with them. The very preachy attitude that this administration has on some matters that would be difficult for any administration certainly doesn't help with the patience it needs to push through reforms that would be difficult. But if it is understood that it's done in good faith, they could make some space. They could make some progress. Thanks.
Indeed. Tiffany?
I was just laughing here when Kwame was talking because I completely agree with him. Obviously, I've spoken a lot about sentiment and all that because I truly believe in it. And definitely there's no amount of economic reform that will work if trust is broken. And in Kenya today, trust is arguably one of the most scarce economic resource that we have. And I could speak on various ways of doing it, and that's just textbook, but it does work. Just making public finance transparent, holding people to account, providing tangible public value for all the tax that we are paying, case in point, shift, housing levy. But one thing I really want to focus on is with respect to demonstrating political integrity. And this is where I believe the heart of trust truly lies. That's the integrity of our leadership. And there's a complete disregard, in my opinion, for the current regime, at least the current regime, that the citizens are watching. We are adults, we are watching, and we know what is happening. And what we're watching matters to us. It's not that we are seeing our own things, it's our reality because we're also living it. So being able to rebuild that trust needs to stem from the fact that the leadership needs to hold people to account. And I'm not talking about corruption. Even statements, very pedestrian statements being made on TV. I keep wondering, don't people know that these things are recorded and they're for life online? I don't understand it, but holding public officials to account how they conduct themselves publicly as well as privately, because all this comes out to us and we as the citizens are watching them, as well as reducing political wastage, and in the same breath talking about cutting spending on non-essential spending, yet we're seeing political wastage. I don't understand that. It needs to make sense to me. And just ensuring that the reforms that this government or the leadership is taking into consideration is impacting everyone, meaning that's applying to everyone, not just a few. So that's just the major thing for me. Political integrity is really lacking, and that will be one way of building or rebuilding that trust.
Indeed. And I don't think you'd be wrong, Stephanie, in saying that, just to put a bit of color into what you're saying. A lot of the pain, the economic pain, has been essentially pushed out to the private sector, to individual households, not just in loss of economic opportunity, but that diminished income that we've seen over the last 5 to 10 years. And fortunately, the guys who are telling us about reaching the policy of reform are not taking any of the pain at all. Dixon, you get the last word on this one.
Yes, I think mine's going to be a bit more philosophical. I think the worst kept secret in Kenya is that the best business as an entrepreneur could ever get into will have the politics. If you look around at who is spending the most money, it's more likely to be a politician, whether it's an MP, a governor, at the executive level. So ultimately, this ideally has become a very profitable venture where you invest billions, and once you get in there, you're going to get some sort of reward. The full political architecture that we have right now, we know that by and large, a good chunk of the money we send to the county will be spent in probably the current expenditure, whether it's someone hiring relatives and cronyism, crony capitalism, procurement is for friends, and any national business trying to procure probably will not get paid because it will not juice the system, so to speak. That means that the procurement costs for the county, given that they most likely will not pay you, or the insiders procuring for themselves might be 2-3 times the cost of the same goods in the marketplace. And literally, if you think about the whole architecture of the politics, it is meant to work as a business. Now, the answer to that, philosophically, will have to be the voter. Because if the voter was not voting really bad people with terrible integrity, if the voter was happy to replace and demand, because we do demand via protests between the 5 years, but once we go to the ballot, we still put the same chaps back in. To me, the solution has to be a smaller government. It has to be a point where, by and large, most of the spending the government should be either directly to the citizens, whether it's through e-vouchers, things like education. Most people have issues prioritizing education. Maybe it might be one thing you do where you spend 10 or 15,000 per child per household, and then you go through the education, and your work is just to inspect and make sure that the schools are hiring competent teachers and they're running education. That budget of 700 billion probably be enough to run the whole school system. Will be a lot less being eaten. You'll be able to see that money going to communities. Healthcare, maybe probably the drugs are stolen, and there's a lot of false claims coming through. ultimately, because the public sector can run genuine businesses without putting graft, and the only business that can survive as public entities is the monopolies. In which case, then, even then, you find that the cost of service provided, whether it's power or energy, whatever it is, it's 3-4 times what your neighbors are paying. Even if the company becomes profitable, there's a lot of risk in the system, and that is added to the cost of the country. So ideally, the whole political machinery, given that it cannot be clean, then rationally, then we should be talking for smaller business. Instead of that, or then you just collect less taxes and then offer less services. If the money was left in the private sector, then the private sector will provide those services. And because you've taxed people less, then they'll end up being able to purchase those services. And then use that for this distribution to lower income households to be able to afford these services for the ones who are not able to work for themselves. Because as long as the incentive for the politicians is to invest, to go in, then they'll always want a bigger budget because that's where they'll be able to get their money. If the cost of debt, for example, is going up, is not a concern for them because what they really care about is what is going over and above that. Because it's a short 5-year will to make a return before you're thrown out or before you have to raise another bunch of money to run for the next campaign, then the whole system is geared towards trying to compensate these people for the money they invested to get back in. In a rational world, would be the voter would be the ones who would really invest it. But the voter seems unable to get beyond whether it's personal interest or bigotry or whatever it is, or the political side is really good at PR and they saw the narrative that the other side is a problem. So you're always trying to fight between the two sides. We end up in this rat. And maybe in democracy, when people are so poor, it doesn't really work because the voter cannot be rational when he's just thinking about the next meal. If we had a $10,000 per capita income, for example, and our government came in and that dropped to 8,000, the pain across the economy will be so huge. I don't think it will even last a couple of years before being thrown out because there will be personal interest manifests over a longer period of time. And eventually we end up with this cycle that is impossible to break.
Indeed. I'm just going to read out a couple of quick comments that have come in response to the discussions we've had at the moment. Dexter Moremi is talking about how he reckons, rather, based on a conversation that we had, that we are not appreciating how hard it is to actually downsize the public sector. You've got to consider union backlash, public opinion, political survival, among other things. Not easy, but I'm willing to bet that the counter argument to that will be we also are on an unsustainable fiscal path at the moment. So either we make those changes ourselves when we still have the room and the time to do that, or we get forced to do it when eventually you have a fiscal crisis, Ghana style, or potentially worse. Ladies and gentlemen, thank you very much for your time this evening. I know you could be doing something else on a Thursday night. We certainly don't take your time and your attention for granted over the last hour and a half. My thanks to our panelists, Kwame Wino, Dixon Magacha, and Stephanie Kimani for having this conversation with us and having conversations especially around where do we go from here? How do we get this economy out of the rut that it's stuck in at the moment? But by all means, this is not the end of this conversation. We'll certainly have a lot more in future. Keep tabs on the Mango Capital account for many of those. When they come up, you'll send see the posters over there. And of course, follow us on our handles. Kwame, Dixon Magacha, and of course, Kimani Stephanie as well. And we can continue having these conversations over the next couple of weeks, months, and potentially years. Thank you very much for your time and attention. Have a good night.